On as TradFi enters, how can crypto native funds maintain their edge?
So let's start with you, Sean. Go ahead.
I'm Sean Farrell, head of digital asset strategy at Fundstrat Global Advisors. We work with institutions and retail investors to guide them through crypto market cycles. My goal is to provide crypto research that mirrors the best of macro and equity research.
My name is John D'Agostino. I'm head of institutional strategy at Coinbase. I'm a board member of AIMA, which has about 9,000 members, about 2,000 hedge fund members, and I'm on the board of directors of a couple of crypto funds, including Polychain and Wincent.
I'm Julia, COO of Caladan. We're a market maker that has been around since 2017, headquartered in Singapore, and we just opened our New York office, so happy to be here in North America.
And I'm Rumi Morales. I'm a partner and board member at Outlier Ventures. We are a Web3 accelerator. We've been around for 10 years, preceding a number of decentralized networks. I also just work at Goldman Sachs and the CME Group for a long time, but I'm definitely wearing my crypto native hat for this conversation.
Thanks, everyone. So as mentioned, Pascal, President and CEO of 3IQ. So why I'm excited to moderate this panel is we were one of the OGs in terms of digital asset managers in Canada. We helped to write the playbook here. We're the first to launch the ETFs and then expand it into a bunch of other different lines of business. But the question we're asking here, which I know in our prep calls, we had some pretty strong ideas and strong sort of debates in terms of where the space is going. For those who came in early, and this is something we faced as well, how do you reinvent yourself when you know that for the space to grow, the big names that have helped the space grow, like BlackRock and others, has been great, but the OGs in the space, the innovators, how do we grow and pivot? And so my goal here with this panel is less about questions and answers. It's more about we're going to three different phases. The first is, what's the problem that we're seeing right now? What's the challenge that we're facing? Then we're going to talk about pivots that we can look at, how do we innovate, how do we change, and then hopefully some opportunities. So maybe Rumi, and also the boards, across the board, we got different types of strategies, liquid strategies, venture strategies. So we should be very relevant, ideally, for everyone in the crowd. So maybe Rumi, you had a lot of sort of pain points on the venture side that you were talking about, and you showed a graph that kind of really startled me. So maybe start there. What's the challenges you're seeing in your space?
Sure. And the graph just showed how few solely crypto-focused VC funds are being raised in the past couple of years. It's been a very interesting dynamic. I was talking to someone just yesterday about how I feel like I've gone through the full life cycle in crypto VC investing, while most people don't even know that it happened. But 10 years ago when Outlier started, there were maybe 2,000 or 3,000 tokens out there. And our focus is on being able to invest in the best of the decentralized networks and help them grow into real communities that produce true value. Now there are 50 million tokens out there. So how are we going to be finding those best and giving them that chance to succeed and to break through the noise? It's not just an Outlier issue. I think this is what we're seeing across the board for many VC funds that are investing in tokens.
And I know that the previous game on the venture side of basically raising capital, get early liquidity, that's changed regulation, delisting. Maybe John, on the Coinbase side, you could talk a little bit. Like the game has changed a little bit in terms of how to list things, which is impacting, of course, the venture space and the innovation. But what are you seeing on the liquid side and some of the things you're working at? What are some challenges that you guys are trying to overcome at Coinbase?
So on the liquid fund, hedge fund side?
All the above. In asset management, I mean, you guys are the big guys in the room, but at the same time, you have stiff competition coming in. So
sure. So I'll just talk about funds' ability to raise capital. So it's liquid hedge funds. So just stepping back, like this is not a crypto problem. So BTIG is a boutique investment bank that has a lot of small hedge fund clients. They told me the other day that in the last 2 years, close to 90% of funds under $200 million have not raised a single dollar of fresh capital. Just understand that. So the distribution model for funds is broken. The old days used to be you started a hedge fund, doesn't matter what the asset class was, put up some good numbers, keep your head underwater, keep quiet, and then they would find you, the fund to funds, or this group of like anywhere from 4,000 to 7,000 investors of hedge funds around the world. Their job was to find you, and they generally would. I started a hedge fund back in 2002 as a junior partner. Literally, like there was a knock at the door one day. He was like, "I heard you guys were up 20% this year, and here's $20 million." Like it was really easy to do. I had a reputation as someone who could raise capital quickly, but a monkey could have done what I did back in that day. So that's gone. It's completely gone. The yes, you'll hear idiosyncratic events. So these guys raised $500 million. There's almost always a story behind it. They had a relationship. They had an innovative structure. Something that the days of just having your Cayman Delaware vehicle, putting up numbers and raising money are done. So you've got to be creative and be thoughtful. Now, one of the ways that TradFi is doing it is they're going more into SMAs and managed accounts. That's a pretty effective strategy. Abu Dhabi Investment Authority will not write a check to a pooled vehicle anymore. Full stop. They have a thing called Blue Pearl in the Cayman Islands. It has close to $90 billion of capital in it. It's an SMA platform. If you want money from Abu Dhabi, you go on Blue Pearl. I know because I'm a director of Blue Pearl. And when they decided to launch it 2 years ago, I'm like, you guys are crazy. I don't care who you are. The hedge funds, the top hedge funds will not do this. Every single hedge fund did it. All the brand names that you think don't need to do it, they all agreed to do it. So it's a system-wide problem. You've got to get creative about how you think about raising capital. You have to offer co-invest, SMAs. You have to have, you want LPs to be your partner in addition to putting up really good numbers and having a unique strategy.
I think one of the phenomenon that I'm seeing is that increasingly more and more players are pushing into asset management. You've got custodians becoming asset managers. You've got data providers becoming asset managers, right? Everybody is trying to become an asset manager because that's where they believe the margins are. And so there's increasing, pressure on what is an asset manager even anymore.
So that's a great question, and one way we could talk about in terms of the pivot side. But Sean, on the liquid side, like you guys at Fundstrat did a great job at helping Bitwise originally. Well, full disclosure, we're working together on some stuff, so you guys know how to basically spread the message, educate. What you had a lot of you brought a lot of great points. So as you're helping some of these emerging asset managers trying to differentiate, talk about on the research side, how harder is it getting for you guys to sort of find that uniqueness in people working with you trying to find distribution?
Yeah, so I mean, I guess first to expand on my colleague's point here, I think what you're getting at is how overly financialized, some would argue, the world has become, how large the pool of capital looking for somewhere to go and the pool of potential suitors has become. And I think that is a challenge in and of itself. And by extension should be woven into the core thesis behind crypto, which is ultimately an asset class that should protect you in a world that is increasingly financialized. But back to your point, I think that, at the core of the problem, I think, the title of this panel is, how can crypto natives keep their edge? And, in the panel before this kind of, alluded to this whole dynamic, but I think a lot of the crypto native fund managers, crypto native operators are still operating in their little bubble. And kind of where I see myself is trying to take this bubble and find bits and pieces that rhyme with, things that market participants in traditional financial markets are familiar with, and just, manipulate what crypto natives are saying and translate that into something that fund managers can understand. And I think that's a big gating factor right now for capital that is, among other things, that is looking to come into the space, and a way that I think crypto funds can, really improve in capital raising initiatives.
The bubble, describe more. That's a great, great word, but describe more in terms of when you say we're all in the bubble here at the conference, and all of a sudden you go somewhere and you talk to an institution, and we're educating some of the banks, and they're asking basic questions that we think they should have known for years ago. So when you're talking about the bubble, is it the fact that we think that the world is further ahead in crypto?
Yeah, absolutely. I mean, we are a pretty forward-looking organization at Fundstrat. Our founder, Tom Lee, he was one of the first individuals on the streets covering Bitcoin back in 2017. He caught a lot of flack for it at the time, but it was obviously had a lot of foresight, and people are happy about that now. But even within our own organization, I'll just bring up some topic. It might be something as simple as staking, and I'll have half of our meeting room come up to me after and be like, I never have any idea what you're talking about. What is staking? And I'm just baffled because this is a very simple concept that we talk about every day. But if you can shift your talking or just articulate what staking is in a different manner, it's like it's a deposit, right? And that you're putting at risk in exchange for promise to do a service or something along those lines. I'm sure I've written something a little more articulate than that. My point is that there are people around you that don't speak our language, and I don't think we appreciate that fact, and we should try to
Okay, so
make adjustments.
quick recap. Venture capital is very difficult to raise. Hedge funds are having a hard time because it's just not about performance anymore, and access is difficult, and we're living in a bubble. So now let's move into the second part and try to be a little more solutions oriented for the crowd here. How do we pivot? How do we solve for this? How do we keep advancing the space as it becomes more and more dominated by some of the larger players? Who wants to take this on first?
I'm happy to say, like, from my perspective, like, we have to evolve with our asset class as that is greatly evolved too. So yeah, there used to be 4,000 tokens. Now they're 50 million. What are you going to do? I think one of the areas I'm particularly interested in is around merger and advisory of different tokenized networks, especially ones that are very similar to each other. At Outlier Ventures, one of our tokens, Fetch, did this with Ocean and SingularityNet. So the three of them are together in the artificial superintelligence token that's out there. I think we see more of those opportunities. And the reason why that's important and not a traditional VC or even financial institution could do this is around the token engineering. This is still ultimately a technology. We're not just investing dollars. You have to have the technological chops. Talking about staking, you have to understand what's happening from a technological perspective beyond just advising on M&A. So that's a unique edge.
You helped facilitate this?
Not directly, but yeah.
But yes, as a firm, you were...
As a firm, I can't say we were pivotal, but we were part of the process.
Very cool.
I'll say two things. I think one is that traditional capital wants traditional wrappers, right? So I think whereas, in the days of 2019, 2020, Edge as a asset manager meant being in the right Discord groups or, knowing the right people to follow on crypto Twitter. I think now Edge lies in your compliance team and your operations team. We're seeing, for example, increasingly the teams that are successful, they're not running very simple, arbitrage strategies across two exchanges anymore, for example, or they're not just doing simple yield farming. Like, those days are gone, right? They're running very complex multi-leg strategies where you have to maintain margin and move capital across multiple venues, across CFI and DeFi and TradFi. And that is an operational problem. That is a compliance problem to be able to get access to those venues, right? They're the ones who are able to present to LPs in a very professional, buttoned up, polished way. They have the prime broker relationships, and they have the banking relationships, and they have the, fund admins, and they have everything lined up. But they're also, and I think this is a question, like, how do you keep your edge? Our edge was in being early. Our edge was in being early into a space when no one else would take a risk on it, right? And you have to keep that edge, and you have to be able to keep pushing out into new strategies.
Yeah, everything she said. Plus, I agree with everything you said. Plus, just get out of your own bubble and understand that let's say you are truly a unique special snowflake. Let's say you actually can produce an incredibly high Sharpe, high Sortino. You have good upside capture ratio, good downside loss avoidance. The way you communicate that to, again, depending on the type of, like a high net worth individual who just wants to put some money and have some fun, you have a personal relationship, that might work. But I can't tell you how many times I've heard pensions being pitched for crypto with some version, some permutation of, oh, you need to be in this asset class because it has this asymmetric upside potential, and fine, it's a low allocation, but it could go up 10,000% and you should invest. Well, you're describing a lottery ticket. Pensions don't buy lottery tickets, and if they were going to buy lottery tickets, there's lots of other lottery tickets. They can buy upside call options. They can invest in early stage venture that don't have all the hair associated with not crypto per se, because crypto now is institutional, but you, meaning a small fund with 2 people and no compliance officer. So don't sell yourself on that, because that's just not realistic. Instead, and then also don't sell yourself on non-correlation, because we are correlated when things are bad. That's when there's pure risk off at the worst possible time, everyone's non-correlated. But what is unique is during normal state periods, non-high stress periods, there is a slightly neutral negative correlation. It is a unique universe of relationships. It is unique access points, unique forms of custody, things that most investors don't want to bother doing. And if you go in there honest, if you get out of your head, okay, I'm going to be a Cayman Delaware hedge fund that charges 2 and 20, and you're thoughtful about your fee structure. If you do think you can put up 3, 4, 5, 6 handles on moderate amounts of capital, look into fulcrum fee pricing, where you get paid in tranches. So the first 10%, it's a 20%. Next 10%, it's a 18%, so on and so forth. So give the investors something back if you achieve those outsized returns, and be willing to put your money where your mouth is in the beginning. Again, every time you read about a crypto hedge fund raising a large bomb of money in early days, they have given something up for it. They've given up part of the GP. They've given up fees. They're looking to earn the right to manage that capital at moderate fees over time. That would be my advice.
Yeah, and I think not to be blunt, but I think what I had said earlier pertained to helping crypto native fund managers on the capital raising side. But I think the number one thing that fund managers could do is just be better. Let's just call it what it is. Liquid funds have gotten absolutely.
You sound like my dad.
Well, we're sitting here. Bitcoin is trading over 100K. And because of the bubble dynamic that I had just mentioned, 8 out of 10 funds you talk to have not kept up with Bitcoin. And I know everybody in here, we appreciate that Bitcoin is different, but that's not how pensions see it. That's not how people that are crypto curious see it. That is our benchmark. And I think that recognizing things like changes in market structure. We had ETFs launched, and everybody was expecting when Bitcoin rallied that, flows would rotate into alts. But that didn't happen because the people buying our bags were buying them in their brokerage accounts, and they were not rotating into XYZ alt. And, our capital our capital allocators, our funds, in our crypto native bubble did not recognize that. And I might be talking my book a little bit here, but I think bringing some expertise in house that can, understand macro, understand traditional financial markets, give you a better read on things like that will help you outperform over a cycle. And if we better anchor ourselves to that Bitcoin benchmark that I think, all of this capital waiting on the sidelines to come into the space that is how they are perceiving that as our benchmark. I think that mentality will go a long way in helping fund managers and capital allocators in the crypto native circle.
So on our side, we kind of took the approach, if you can't beat them, join them. We've been integrating, trying to be the Trojan horse to integrate with the bigger guys and helping to educate, but locking in some services and trying to launch products for them. So if anyways, the collaboration aspect didn't come up. The M&A came up. Be better performance at the same time. Traditional, I completely agree. Operations and wrappers and compliance is a game changer for the TradFi space. Let's push it. We got a few minutes left. Let's push it one step a little more creative into the future. Every disruptive technology, I've been in early web, early open source, early AI, has a moment where the technology, we try to find a way to integrate it into how we know the world works. And then one day you wake up and it's something new. And that something new hasn't happened yet here, but it will happen at some point. One clear example is telecom. Like back in the day when cell phones were coming out, or even voice over IP, North American telcos were like, stay away from that. It's going to disrupt my long distance business, could disrupt my other business. Now they provide all of this. But you had emerging markets saying, why are we going to build landlines when we could just go straight to 5G? So what does that moment look like in asset management in the crypto space? We're talking about, wrapping overseas and ETFs and those kind of things. What's the 0 to 1 moment where the technology creates something net new? And I'm sorry I didn't bring this up in the prep panel, but I like always keeping people on their toes. So how do we end this with what does the future look like?
Well, I think, a few things. One, we're starting to see a lot of momentum. Larry Fink has mentioned, I think, two things very publicly. One, he loves Bitcoin. Two, he loves tokenization. And I think that in the very near term being next 12 to 18 months, we're going to see real valuable assets that are linked to the real world, not the crypto bubble, be ported onto these crypto rails, which, I think it's a great analog, to all of the broadband that was laid. We have the broadband. We're going to have some very valuable services, very, very valuable assets bridged to our bubble. And I think that's going to be massive because, you're going to have all of these players, institutions interacting with those rails. So I think that's going to be big. The other thing that I think we're starting to see in the market is more discretion around asset selection. We still need to make some progress on, metrics and deciding on, consistency around how we evaluate these different protocols, right? We don't have P&Ls, but, we do have supply, demand, fees, emissions, things like that, we can all aggregate around and agree are how we're going to be speaking about these things, because it's not necessarily always about upside matters, but what price you buy at, I think, is perhaps the most important thing. And yeah, I think I had a third thing, but it's escaped me. So that's it.
Sure. So as I mentioned, I think my issue is I think the distribution models are broken. So to answer that question, I would say what would be innovative? So tokenization of funds is fine. I mean, it's mostly a marketing gimmick, to be honest. Yeah, fine. Would I rather buy a token than fill out a PDF? Sure. But most of the time when I hear people say democratization of finance and tokenize my fund is because they've run out of dumb people to buy their fund because it sucks. But so until we have like the best funds saying you can't buy my fund unless you do it this way, it's a garbage in, garbage out problem. But what would be cool is, Coinbase has a thing called verified pools where you can create these micro markets of pre-approved, accredited, and qualified purchasers. Because one thing that hedge funds don't like is people trading their LP shares. That's why they all get ROFRs on their LP shares. They're very locked up about that. I want to know who my investors are. I could see that changing over time because that is so. Buy my fund in a tokenized format. Well, okay, fine. Why? Because if you do it, you get thrown into this verified pool, and we can create some liquidity around the LP shares, and we'll allow it to trade freely. That I could see LPs actually caring about. Now, then the next question is, will you actually have liquidity in that pool? Well, if you maybe Coinbase we can think of something where we open it up to other verified participants. But if funds can create real venues for liquidity for their LP participants over time and not care about the discount or premium that the share trades at, because ultimately, if you're confident in your alpha ability and someone's dumb enough to sell their LP share at a discount, well, they're going to look stupid later because you're going to bang out 20% next year and they're going to look dumb. So that would be a true change. I think that helps LPs, that differentiates funds. It shows manager confidence. And I could see then tokenization meaning something.
I think, I was sitting in the office, this very, very nice office overlooking like Central Park last week, talking to a large multifamily office, right? And what they were saying to me, he said something that I thought,
The family office does not want to divulge their secrets, clearly. So
what he said to me was, in addition to all the DD that he does on the actual strategies, what he's really looking for is a manager that can keep iterating new strategies, because he believes that the half-life of any profitable strategy in crypto is about 18 months, right? So I think it's about continuing to be innovative, continuing to be creative. And I'll give you some examples. One area where we've been seeing innovation recently is in being able to generate yield on BTC that's still held in cold storage. Like, what are innovative ways to do that, right? I think Maples is rolling out something quite innovative there. Another one is I had a conversation yesterday with Link, who is having a tokenized fund that you can use for settlement, right? So you don't have to go through traditional banking rails for settlement. Now, those are just two examples. But fundamentally, we got into the space because it was new, because you could do new things with blockchain. And I think that is where the edge is going to continue to be for crypto native funds to continue pushing out and, creating things rather than just trying to catch up with TradFi, because we're not going to win that game. They're already there.
I would just say, for me in the future as a VC, I totally expect not to be here, not to be needed, rapidly being disintermediated by AI. And I say that in reality because that's actually part of what we're working towards or considering. If you think about the unique data sets that we have as investors going back a decade or longer across all of these different protocols and investments, and what worked and what didn't, what won and what didn't. It's interesting data, right? And on top of that, you think if you've ever engaged in a DAO before, as an investment vehicle, many times like DAOs are great in theory, but you run into human governance challenges, personality clashes, and just the community interest fades. But if you have AI, your interest can stay as high as you want it to be for as long as you want it to be. So I wouldn't be surprised to see more agentic DAOs on the horizon, as well as other things that get much more coded from a VC perspective in terms of decision making.
Well, look, I think we're out of time. I think this has been a great conversation. Hopefully, it's been useful for the crowd here. But I think the conclusion here is, if you're struggling today, keep pushing into the future. We were in Canada, so I'll use this analogy of skate where the puck is going. I know it's hockey playoff season. My apologies, but the performance, from the conclusion, performance only doesn't matter anymore. Distribution, compliance, innovation, and try to simplify the message is sort of the key takeaways I've heard here. So, anyways, I'll pass it on to the next panel, and thank you all for taking some time to hear us today, and thank you to the panelists.
Thank you.